Your retirement account just became part of the largest financial experiment in history. Every dollar sitting in your 401k, every paycheck you've saved, every investment you've made for the future, all of it now exists inside a system that's quietly breaking apart, not because of a stock market crash, not because of some satisfying point where cable news anchors start shouting, but because of something far more dangerous, mathematics that no longer work. January 1st, 2026 marked the exact moment this became irreversible. On that day, China activated an upgraded framework for its Digital Yuan, new management systems, interest-bearing wallets, deeper integration with the global financial system. Sounds technical? Sounds boring. Sounds like something you can safely ignore. Here's what nobody's telling you. This isn't about China becoming more powerful. This is about America's ability to finance $38.4 trillion in debt starting to disappear, not in a dramatic crash, not in a single moment you'll remember, but through a slow, methodical erosion that's already underway. And the $318 trillion number, that's not the national debt politicians argue about on television. That's something far worse. And I'm going to explain exactly what it means for your money. Not so you panic and sell everything tomorrow, but so you understand what's actually happening right now. When politicians talk about $38 trillion in national debt, they're only telling you part of the story. It's like looking at your credit card balance while completely ignoring your mortgage, your car loan, your student debt, and that promise you made to pay for your kids' college. As of January 7th, 2026, total gross national debt stands at $38.43 trillion. That number comes directly from the Joint Economic Committee. It's real, it's verified, and it's growing by $8.03 billion every single day. Let me break that down. $334 million per hour, $557 million per minute, $92,900 per second. By the time you finish watching this video, America will have added millions more to the pile. But here's what they don't mention on the news, that $38.43 trillion is just money America already borrowed. It doesn't include what America promised to pay. Medicare alone carries an unfunded obligation of $52.8 trillion over the next 75 years. That number comes from the 2024 Medicare Trustees Report. Social Security adds another $25.4 trillion in unfunded obligations. That's from the 2024 Social Security Trustees Report. Federal employee and veteran benefits. The 2024 Financial Report of the United States government lists $15 trillion sitting on the government's balance sheet. When researchers at the Penn-Wharton budget model calculate the complete picture across all current and future generations, the federal fiscal imbalance reaches $162.7 trillion. Add state and local government debt. Add unfunded pension liabilities at every level. The House Budget Committee now references $148 trillion in total unfunded liabilities for Social Security and Medicare alone. Some broader analyses push the complete liability picture past $175 trillion. Others calculate north of $200 trillion when measuring properly across all levels of government and timeframes. That's the real number. Not $38 trillion somewhere between $140 trillion and $200 trillion in total obligations. And here's why this matters more than any political debate you've ever watched. America doesn't have a debt problem. America has a financing problem. Every empire in history shared the same fatal weakness: Rome, Spain, Britain. Every single one depended on other people being willing to lend them money. Every single one collapsed when the mathematics stopped working. America seemed different for one reason. We convinced the world they had no choice but to use our system. If you wanted to buy oil from Saudi Arabia, you needed dollars. If you wanted to trade with Europe, you cleared through American banks. If you wanted to participate in the global economy at all, you held U.S. Treasury bonds. This wasn't coercion, it was convenience. The dollar was simply the best option available, the most liquid, the most trusted, the most widely accepted. But here's what changed on January 1st, 2026. China just made convenient optional. Right now, America is spending more money on interest payments than on protecting the country. Let that sink in for a moment. In fiscal year 2025, the federal government spent $970 billion just on interest. That's according to the Department of Treasury's September 2025 monthly Treasury statement. National defense, $917 billion. Interest payments are now higher than the entire defense budget. 5 years ago, this wasn't even close. In October 2020, America paid $345 billion in interest over the previous 12 months. Today, that number has nearly tripled, from $345 billion to $970 billion in 5 years. And it's accelerating. In the first quarter of fiscal year 2026, October through December, interest expense hit $270 billion. That's the second largest spending item in the federal budget. Only Social Security came in higher at $402 billion. Interest payments now exceed national defense spending. They exceed Medicare spending. They exceed Medicaid, veterans benefits, education, and transportation combined. This is the invisible part most people miss. Here's why it happened. The average interest rate on total marketable national debt reached 3.362% as of December 2025. 5 years ago, that rate was 1.552%. That difference sounds small. It's not. Every single percentage point increase in interest rates forces America to find an extra $380 billion every year just to service existing debt, not to build anything, not to fund any program, just to pay interest on money already borrowed. Think of it this way. If you have a $500,000 mortgage at 3%, you pay $15,000 in interest annually. America's mortgage is $38.4 trillion. The Congressional Budget Office now forecasts net interest as a share of outlays will hit 13.85% in fiscal year 2026, then 14.11% in fiscal year 2027, then 14.52% in fiscal year 2028. Those percentages keep climbing because the debt keeps growing and interest rates aren't dropping fast enough to offset it. In the 2019 fiscal year, net interest expense totaled $375 billion. That was 1.7% of GDP. Manageable? Forgettable? Nobody talked about it. By fiscal year 2025, that figure jumped to $952 billion, a rise of 153% in 6 years. Interest gobbled 3.2% of national income, almost twice its share before COVID. From FY 2019 to FY 2025, interest spending soared from under $1.10 to more than $1.06.5 of all federal spending. And here's the projection that should keep you awake. The Congressional Budget Office estimates interest payments will grow from $1 trillion in fiscal year 2026 to $1.8 trillion by fiscal year 2035. That's a 76% increase in 10 years. Interest is projected to grow faster than any other major category in the federal budget, faster than Social Security, faster than Medicare, faster than defense. This creates a mathematical trap that's almost impossible to escape. Higher interest rates make the debt more expensive to service. More expensive debt means larger deficits. Larger deficits require more borrowing. More borrowing means more bond supply. More supply with questionable demand means even higher interest rates. The cycle feeds itself. And every dollar spent on interest is a dollar that can't be spent on anything else. Not roads, not schools, not defense, not health care for seniors, just payments to bondholders for the privilege of borrowing money America already spent. Here's where it gets genuinely frightening. America doesn't just pay interest on existing debt. America has to constantly roll over maturing bonds. Every single week, billions in Treasury securities mature. The U.S. Treasury has to sell new bonds to pay off the old bonds. It's like paying off one credit card with another credit card, except it only works if someone is willing to keep issuing you new cards. Half of all outstanding U.S. debt matures by 2026. That's roughly $7 trillion that needs to be refinanced in the next year alone. Each percentage point increase in interest rates on that refinanced debt means $70 billion more in annual payments. For decades, this rollover was automatic. Foreign central banks needed dollars for trade, so they bought treasury bonds. American investors wanted safe assets, so they bought treasury bonds. Pension funds had legal requirements to hold government securities. The system worked because everyone needed dollars. That's changing. China held $132 trillion in U.S. Treasury securities at its peak in November 2013. As of October 2025, that number dropped to $688.7 billion. That's the lowest level since November 2008, a decline of more than 47% from peak holdings. China has been selling consistently since President Trump's first term, not because they hate America, because they need fewer dollars. Chinese financial data provider. When confirmed, the October figure represents a continuation of a multi-year trend, and this trend is expected to accelerate through 2026. Here's what happened to the rankings. Japan remains the largest foreign holder of U.S. Treasuries at $1.2 trillion as of October of 2025. That's up from $1.059 trillion in December 2024. Japan is still buying. But the United Kingdom has now passed China as the second largest holder. The UK held $867.9 billion in October 2025, up from $864.7 billion in September. China slipped to third place in March 2025, a position it had never held in modern history. Now look at the bigger picture. Foreign ownership of the U.S. Treasury market peaked above 50% during the global financial crisis. Foreigners were the dominant buyers. They set the prices. They kept rates low. As of early 2025, foreign ownership dropped to 30%. That's a 20 percentage point decline in foreign participation over roughly 15 years. Total foreign holdings still exceed $9 trillion. That number remained above $9 trillion for 8 consecutive months through October 2025. Foreigners are not fleeing entirely, but they're not keeping pace with the growth of the treasury market either. Here's the problem. When foreigners held 50% of the market, demand was essentially automatic. The U.S. could issue bonds with confidence that buyers would show up. At 30% foreign ownership, with the largest historical buyer actively reducing holdings, the math changes. Someone has to absorb the difference. The Federal Reserve can buy bonds, but that creates inflation. Domestic investors can buy bonds, but they demand higher yields when supply overwhelms demand. The Treasury can issue shorter-term debt, but that increases refinancing risk. None of these options solve the underlying problem. They just shift it somewhere else. And here's what connects this to your retirement account. When China held $1.3 trillion in treasuries, they were funding American deficits. When they hold $688 billion and dropping, that funding has to come from somewhere. Either interest rates rise to attract new buyers, or the Federal Reserve prints money to buy the bonds itself, or the government cuts spending and raises taxes dramatically. Each option has consequences. Higher rates mean your mortgage costs more. Printing money means your dollars buy less. Spending cuts and tax increases mean less money in your pocket. There's no escape hatch that doesn't affect you directly. And here's what accelerates all of this. China isn't just selling treasuries, they're building an alternative system so they never need to buy them again. This is the mechanism most people completely miss. The digital yuan isn't trying to replace the dollar everywhere. It doesn't need to. It just needs to create a parallel system where countries can bypass dollar-based settlement when it is more efficient. And that's exactly what's happening right now. Project mBridge is a cross-border payments platform designed to enable direct settlement between central bank digital currencies. It started as a small pilot under the Bank for International Settlements Innovation Hub. Today, it's processing real money at scale. According to data from the Atlantic Council released in January 2026, Project mBridge has now processed over $55.49 billion in cumulative transaction volume. That represents a 2,500-fold increase since the project's early days in 2022. Not 25 times, not 250 times, 2,500 times larger. And China's digital yuan accounts for approximately 95% of total settlement volume on the platform. The participants include the People's Bank of China, the Hong Kong Monetary Authority, the Bank of Thailand, the Central Bank of the United Arab Emirates, and the Central Bank of Saudi Arabia. Read that last one again. Saudi Arabia, America's oldest Middle Eastern ally, the foundation of the petrodollar system, the country that agreed in 1974 to price oil exclusively in US dollars in exchange for American military protection. Saudi Arabia joined mBridge in 2024. They're not doing this to hurt America. They're doing this because the technology is objectively better. The platform processes over 4,000 cross-border transactions. Settlement is instant. Costs are lower. Currency conversion happens automatically without touching the dollar system. Think about what that actually means. When Thailand buys oil from Saudi Arabia the traditional way, they convert baht to dollars, send those dollars through American correspondent banks, then Saudi Arabia converts dollars to rials. Every single step involves American financial infrastructure. Every step generates fees. Every step creates demand for U.S. Treasury bonds as reserves. Now they can transact directly on mBridge. Instant settlement, lower costs. No dollar exposure needed. One transaction doesn't matter. 1 million transactions start to matter. $55 billion in transaction volume starts to change the mathematics. And the platform is increasingly focused on exactly the sectors that historically generated the most dollar demand globally. Trade settlement, energy, commodities. The Atlantic Council's Alisha Changani stated directly that mBridge will likely focus increasingly on trade settlements, particularly in energy and commodity-linked transactions, where China already plays a central commercial role. If those transactions start settling in digital yuan at scale, the forced demand for dollars erodes, but mBridge is only half the story. Inside China, the digital yuan has exploded. By the end of November 2025, the ECNY had processed more than 3.48 billion transactions, worth roughly 16.7 trillion yuan. That's approximately $2.37 trillion. The system now supports 230 million personal wallets and over 19 million corporate wallets. That represents more than 800% growth since 2023. And on January 1st, 2026, something fundamental changed. The People's Bank of China activated a new management and measurement framework for the digital yuan. Officials framed this as a shift from pursuing digital cash toward deeper integration with the regulated financial system. Starting January 1st, commercial banks can now pay interest on digital yuan deposits. The digital yuan transforms from pocket money into a legitimate financial instrument. Liu Lei, deputy governor of the People's Bank of China, confirmed the system will now receive the same protections as conventional bank deposits through the National Deposit Insurance System. This isn't a pilot anymore. This is infrastructure. China is testing cross-border digital yuan payments in border regions and tourism economies across Asia. Hong Kong, Macau, Laos, Thailand, Cambodia, Singapore. In late December 2025, China completed its first digital yuan consumer payment in Laos. The Bank of China's Vientiane branch connected to the PBOC's cross-border digital payment platform and processed merchant QR payments. Each connection creates another pathway for a trade settlement that doesn't touch the dollar system. The PBOC released a comprehensive action plan covering 2026 through 2030. It includes establishing a digital RMB management committee and operating dual centers for domestic and cross-border systems. They're building this for the long term. Now, let me be clear about something. The Atlantic Council's analysis states directly that Project M-Bridge is unlikely to challenge dollar dominance outright. The yuan still accounts for less than 3% of global transactions according to SWIFT data. But here's the exact quote from their report. Rather than seeking to displace the dollar outright, China is building parallel settlement rails that reduce reliance on dollar-based systems. Project M-Bridge is unlikely to challenge dollar dominance directly, but it may incrementally erode it across specific corridors, sectors, and use cases. Incremental erosion, that's the key phrase. Not replacement, reduction. Every transaction that settles on M-Bridge instead of through the dollar system is one less source of treasury demand, not enough to matter today, but compounding relentlessly month after month. Russia and China now settle approximately 99% of their bilateral trade in rubles and yuan. Egypt announced BRICS member states are increasingly adopting local currency settlements. Brazil and China eliminated the dollar as intermediary currency in 2023. The network keeps growing, the infrastructure keeps expanding, the alternatives keep multiplying. And every percentage point reduction in dollar dependency means marginally less demand for U.S. Treasury bonds, which means marginally higher interest rates, which means marginally higher debt servicing costs. Compound that over a decade. Let me walk you through exactly how this unfolds. This is unlike 2008. There won't be a single satisfying moment where Lehman Brothers collapses and everyone agrees the crisis started. This is completely different. This happens in 4 stages, and we're already past stage 1. Stage 1, the invisible drain. This is where we are right now. Interest payments compound silently in the background. The debt grows by $8.03 billion per day. The average interest rate creeps upward from 1.5% to 3.3%. Nobody panics because the numbers are abstract. $38 trillion sounds like $28 trillion sounds like $18 trillion. The human brain can't process differences at that scale, so we ignore it. Meanwhile, interest expenses quietly surpass national defense, then Medicare, then everything except Social Security. The Congressional Budget Office projects interest will consume 13.85% of all federal outlays in 2026, then 14.11% in 2027, then 14.52% in 2028. Each year, a slightly larger share of every tax dollar goes to bondholders instead of services. This stage feels like nothing. That's what makes it dangerous. By the time people notice, the mathematics are already locked in. You can't unwind a decade of compound interest with a single budget deal. Stage 2. The payment crisis. This is where refinancing becomes painful. Half of all outstanding U.S. debt matures by 2026. The Treasury has to sell new bonds to pay off old bonds every single week. When foreign buyers dominated the market, this was automatic. Auctions cleared easily, rates stayed low. The bid-to-cover ratio remained strong. As of December 2025, the bid-to-cover ratio for 10-year Treasury notes stands at 2.43. For 30-year bonds, it's 2.29. Anything above 2.0 reflects adequate demand. Those numbers look fine today. But watch what happens when China continues reducing holdings from $688 billion. Watch what happens when M-Bridge processes $100 billion instead of $55 billion. Watch what happens when oil transactions settle in yuan instead of dollars. Demand doesn't collapse overnight. It erodes at the margins. The Treasury responds by shortening maturities, issue more bills instead of bonds, keep rates manageable in the short term. As of December 2025, $6.55 trillion in Treasury bills make up 21% of total public debt outstanding. Notes account for $15.63 trillion at 50%. Bonds represent $5.24 trillion at 17%. The reliance on short-term borrowing is already visible, but short-term debt creates refinancing risk. When you have to roll over trillions every few months instead of every few years, you're constantly exposed to rate changes, one bad auction. One unexpected spike in yields. One moment where buyers hesitate. That's when stage 2 becomes stage 3. Stage 3, the currency bypass. This is the mechanism that changes everything. Every transaction that settles outside the dollar system reduces structural demand for dollars. Not temporary demand, structural demand. When Thailand needed dollars to buy Saudi oil, Thai banks held dollar reserves. Those reserves sat in treasury securities. That was structural demand baked into the global trading system. When Thailand buys Saudi oil through Enbridge, they don't need those dollar reserves anymore. The demand disappears, not because anyone decided to attack America, because the transaction simply doesn't require dollars. Multiply this across thousands of transactions, across dozens of countries, across energy markets and commodity markets and trade settlement. The BRICS nations aren't creating a single alternative currency. They're creating multiple bypass routes. Russia and China settle 99% of bilateral trade in local currencies. Brazil and China eliminated dollar intermediation. India pays Russia for oil in rupees and yuan. Egypt, Iran, and the UAE are adopting local currency settlements. The new development bank aims to provide 30% of its financing in local currencies by 2026. China's cross-border interbank payment system now has 1,467 indirect participants across 119 countries, linking 4,800 banks in 185 countries. Each pathway is a bypass. Each bypass reduces dollar demand. Each reduction in demand means fewer treasury buyers. The dollar remains dominant, but dominant with 89% of currency exchanges is different from dominant with 96%. Dominant with 56% of foreign reserves is different from dominant with 65%. The erosion is measurable. The IMF tracks it quarterly. The dollar's share of global reserves dropped from 65.3% in 2016 to approximately 59% by late 2024. 6 percentage points in 8 years. Slow enough to ignore, fast enough to matter. Stage 4, the confidence leak. This is where everything becomes genuinely dangerous. Markets don't price risk in straight lines, they price it exponentially. Right now, U.S. Treasury bonds are considered the safest asset in the world. The risk-free rate, the foundation of all financial modeling. Every mortgage rate, every corporate bond, every derivative contract ultimately references Treasury yields. The 10-year Treasury yield finished at 4.24% on January 16, 2026. The 30-year ended at 4.83%. Those rates reflect current confidence. Investors believe America will pay its debts. They believe inflation will stay contained. They believe the dollar will maintain its value. But what happens when confidence starts to leak? Not collapse, then leak. What happens when bond investors start demanding an extra 50 basis points to compensate for fiscal uncertainty? Then another 50 basis points for dollar depreciation risk? Then another 50 basis points because everyone else is demanding more? Interest rates rise, not because the Federal Reserve raises them, because the market demands higher compensation for perceived risk. This is the death spiral. Higher rates make debt more expensive. More expensive debt creates larger deficits. Larger deficits require more borrowing. More borrowing means more supply. More supply with uncertain demand means even higher rates. The feedback loop accelerates itself. America won't technically default. We can always print dollars to pay dollar-denominated debt. But printing money to pay bondholders destroys the purchasing power of every dollar you hold. The 10-year yield at 4.24% assumes confidence remains intact. The 10-year yield at 6% means mortgage rates above 8%. Corporate borrowing costs spike. Stock valuations compress. Housing prices fall. The economy contracts. The 10-year yield at 8% means a full-scale fiscal crisis. Interest payments would consume over $3 trillion annually, more than Social Security, Medicare, and defense combined. We're not there yet. But the distance between 4.24% and 6% is smaller than most people think. It's a confidence gap, not a mathematical gap. And confidence can evaporate faster than any spreadsheet can model. That's the 4-stage sequence. Invisible drain, payment crisis, currency bypass, confidence leak. We're solidly in stage 1. Stage 2 is visible on the horizon. Stages 3 and 4 depend on how fast the alternatives scale. The Digital Yuan just gave them a timeline. I can already hear the comments. This is fear-mongering. The dollar has been dying for 50 years. China's economy has its own problems. Every decade someone predicts collapse, and every decade they're wrong. All true. But here's what's genuinely different this time. For the first time in modern history, there's credible alternative infrastructure for international settlement that doesn't require dollars, not conceptually, not theoretically, actually built, actually functioning, actually processing billions in real transactions. Project Enbridge processed $55.49 billion. The Digital Yuan handled $2.37 trillion domestically. China's cross-border interbank payment system links 4,800 banks across 185 countries. The technology exists and works. Previous predictions of dollar collapse assumed someone would have to build an alternative from scratch. That takes decades. That requires trust that doesn't exist. China spent 15 years building this quietly. Now it's operational. The network is growing month by month. The incentives align perfectly for participating countries. And the mathematics behind America's debt load gets worse every single day. Those four factors haven't been true simultaneously in modern history. The yuan still represents less than 3% of global transactions. The dollar still dominates at 59% of foreign reserves. India's external affairs minister stated clearly in March 2025 that India has no policy to replace the dollar. Dollar dominance isn't ending next month. But the era of unchallenged dollar dominance is clearly ending. The alternatives now exist. The question is only how fast they scale. That's why this time carries different weight. Here's why you shouldn't sell everything tomorrow. First, these transitions take decades, not months, not years, decades. The British pound was the world's reserve currency before the dollar. In 1948, the pound held twice the global reserve share of the dollar. By 1969, the dollar had overtaken it tenfold. By 1980, the pound represented just 2% of global reserves. That transition took over 30 years. The erosion of dollar dominance won't happen in a single dramatic moment. It happens slowly. Then suddenly, we're still in the slowly part. Second, institutions move last. Pension funds have legal mandates to hold government securities. Central banks have regulatory requirements. Insurance companies need safe assets for reserves. Even if every fund manager in the world saw this coming, they couldn't dump treasury holdings overnight. The market couldn't absorb that selling pressure. The rules don't allow it. Institutional constraints create inertia. That inertia buys time. Third, there's no clear alternative yet. The euro has its own structural problems. The yuan isn't fully convertible. Beijing still maintains capital controls. Gold can't scale to handle global trade volume. Bitcoin is too volatile for institutional settlement. The dollar remains the best option in a world of imperfect choices. India opposes de-dollarization. External affairs. Minister Jaishankar stated in March 2025 that the dollar's reserve currency is the source of global economic stability. BRICS members have diverse positions. There's no unified front. Fourth, timing is impossible. You could be completely right about the direction and completely wrong about the timeline. The market can stay irrational longer than you can stay solvent. The biggest losses don't come from staying too long. They come from leaving too early, watching from the sidelines for years while everything rises, then finally capitulating right before the turn happens. Don't panic, but don't ignore this either. So what do you actually do with this information? First, watch the interest cost numbers closely. The Congressional Budget Office projects net interest as a share of outlays at 13.85% in fiscal year 2026, then 14.11% in 2027, then 14.52% in 2028. If those numbers start accelerating faster than projected, that's your warning sign. It means the debt spiral is tightening faster than expected. Second, pay attention to Treasury auction results. When the U.S. Treasury sells bonds, watch the bid-to-cover ratio, watch the yield. A ratio above 2.0 means adequate demand. Below 2.0 means buyers are hesitating. As of December 2025, the 10-year bid-to-cover ratio sits at 2.43. The 30-year at 2.29. If those numbers start dropping toward 2.0 or below, that's when the financing problem becomes real. Third, track digital yuan adoption in energy and commodity markets. The Atlantic Council identified energy and commodities as the sectors where mBridge will likely focus. Those markets historically generated the most dollar demand globally. When major oil transactions start settling in digital yuan at scale, the structural shift accelerates. Fourth, diversify without abandoning the system. You still need dollar exposure. You still need some treasury exposure for liquidity. But having only dollar-denominated assets in a world where dollar dominance is eroding carries increasing risk. Consider assets that produce value regardless of which currency dominates. Businesses with pricing power, real estate in productive locations, infrastructure, commodities. Things that generate cash flow hold value better than pure financial assets during currency transitions. Fifth, stay invested, but stay informed. The problem with collapse narratives is they make people expect a single dramatic moment. A crash, a default, a headline. That's not how this works. It happens slowly. Revenue falls short of obligations year after year. Financing costs rise gradually. Confidence erodes at the margins. Then one day you look back and wonder when everything changed. Stay in the market, but understand what you own and why you own it. The collapse isn't coming in some future dramatic moment. It's already here. It just moves so slowly that most people won't realize it until they look back 5 years from now and wonder when everything changed. The answer is January 1st, 2026. That's when China activated the upgraded Digital Yuan framework. That's when interest-bearing wallets went live. That's when the parallel system shifted from experiment to infrastructure. Everything after that is just mathematics playing out to its conclusion. $38.43 trillion in debt, growing by $8.03 billion per day. Interest payments consuming $970 billion annually and climbing. Foreign buyers reducing holdings while alternatives multiply. America can handle this debt at 2% interest rates. At 5% interest rates, the math breaks. At current trajectories, we have somewhere between 5 and 10 years before the market starts demanding much higher compensation for risk. But here's what makes this different from every previous warning. The digital yuan didn't cause America's debt problem. America's debt problem caused America's debt problem. But the digital yuan is accelerating the timeline by removing one of America's biggest advantages, the forced demand for dollars, the automatic buyers for treasury bonds, the structural requirement to hold dollar reserves. That requirement is becoming optional, one transaction at a time, one trade settlement at a time, one country at a time. Nothing breaks tomorrow. But the mathematics already broke. We're just watching the consequences unfold in slow motion. Your retirement account sits inside the system, your savings, your investments, your future. Not so you panic, but so you understand. The ground underneath the financial system is shifting in ways that haven't happened in our lifetimes. The certainties that governed investing for the past 50 years are becoming uncertainties. Plan accordingly.